Alright, today's video is a follow-up on my previous video where I share with you my portfolio, but more specifically, the bottom six positions in my portfolio, which are Enphase, Lululemon, Sea Limited, On Holding, Marquetta, and Palantir. So if you're interested in learning more about why I own these stocks, you can head over to my previous video, which I will leave the link in the description box below. So as for today, I will be talking about the rest of my portfolio, which are still blurred out right here. So let's go over each one of them one by one and talk about why I own these stocks and why I'm bullish on them. So without further ado, let's talk about stock number 7 in my portfolio, which is Open Door, ticker symbol OPEN, which represents 5.28% of my portfolio. So for those who don't know, Open Door pioneered iBuying, which basically means buying homes directly from homeowners online through a quick all-cash offer. So basically, Open Door offers home sellers and home buyers an all-in-one platform to buy and sell homes online through the Open Door mobile app or website, essentially digitalizing the traditional home moving experience. Now, here's why I like Open Door stock. First, the company has a superior value proposition compared to the traditional way of buying and selling homes, which is incredibly complex, uncertain, and time consuming. And this is why Open Door has a net promoter score of 80, which is way higher than the industry as a whole. Secondly, the residential real estate market is absolutely massive, valued at $1.9 trillion in 2022, and given Open Door's brand moat and high NPS score, I think Open Door will continue to take market share in an industry where only 1% of the residential real estate market is online. So lots of room to grow for Open Door right here. And third, speaking of market share, Opendoor is virtually operating a monopoly in the iBuying space with a market share of nearly 80% in 2022. To succeed in the iBuying business, the company needs to scale to cover their fixed costs. And because Opendoor has that leadership position, I think Opendoor is well positioned to scale and eventually achieve profitable growth. Now, the company is sitting at a loss right now, but things are actually getting better over the last few quarters with adjusted gross profit and adjusted EBITDA margins trending higher. And as Opendoor enters the warmer months, which are Q2 and Q3, I think we should see volume pickup and that should improve its bottom line. And over time, as Opendoor scales, Opendoor should turn free cash flow and net income positive. However, do note that it will take some time, probably a year or so. So 2023 has not been a good year for Open Door, with revenue down 55.4% year over year. And to make matters worse, analysts also expect revenue to continue to fall by 16.8% year over year in 2024. However, if we break it down by quarter, we can see that analysts expect Q2 to be the last quarter of negative growth at 25.7%, negative 25.7% year over year. And then in Q3 and beyond, we can expect revenue growth to reaccelerate by 62.3% in Q3 and another 74% year over year in Q4 and so on. So when this happens, I think the markets will start to pile in into Open Door once again, which should drive the stock price higher from here. And on the bright side, the Fed is set to cut interest rates this year, which should help with housing affordability, which should subsequently encourage more buying and selling activity. So watch out for the first rate cut because that will be a major catalyst for Open Door stock. And in the meantime, we can buy Open Door stock at a huge discount, still down by a staggering 93.26% from its all-time highs. And it is now trading at an EV to sales forward EV to sales multiple of just 0.51 times, which I think is incredibly cheap. Of course, Opendoor is a very risky stock given that the company is still unprofitable and has a net debt position of $1.4 billion. So the stock will continue to be volatile, so proper risk management is very important here. That being said, I have a price target of $6 a share for Opendoor stock, which is more than double the current price of $2.41. So next on the list is Meta Platforms, ticker symbol META, which represents 8.17% of my portfolio. Now, I won't take too much time talking about Meta because you guys know that Meta is the largest social media platform and the biggest prospect in AI and the metaverse. And as you know, the company's fundamentals are very solid. Gross margin is exceptionally high at 81.5%. The company is already net income positive with a net margin of 32.06% and a free cash flow margin of 34.7%. ROIC over the last 5 years is also very high at 32.37%, and the company has a huge cash hoard of $58 billion dollars with a net cash position of $20 billion. Dollars. Growth has been strong as well with revenue 3-year CAGR of 14.77% and a 5-year CAGR of 19.34%, and is also expected to grow revenue by another 15% per year in the next 2 years. In addition, the company is growing earnings per share very rapidly with a 3-year CAGR of 14%, and analysts actually expect that to grow even more in the next 2 years, growing EPS by a CAGR of 24.5% over the next 2 years. So, fundamentally speaking, Meta is very, very strong. And while the stock has been on a tear lately, up about 39% this year alone, the company still trades at a forward PE ratio of 23 times, which is fairly reasonable considering its quality and its strong fundamentals, as well as its growth potential in the metaverse and AI. You know, valuation is not as cheap as it was back in late 2022 and early 2023, but at the same time, I wouldn't call it expensive here either. In fact, I think it trades right at fair value. And as long as the company continues to grow revenue and as long as the company continues to grow earnings per share at a robust pace, I think a P multiple of 20 to 25 times is well justified. As for me, I have a base case price target of $502 a share for Meta stock, which is very close to where the price is trading right now. With that being said, I won't be a buyer or a seller here. Instead, I will continue to hold my position in Meta stock as long as the fundamentals remain solid and the growth story remains intact. Okay, moving to stock number 9, we have PayPal stock, ticker symbol PYPL, which represents 8.33% of my portfolio. Now, PayPal needs no introduction. They are basically the largest digital wallet and payment processing company in the world. They own PayPal, Venmo, Braintree, and more. If we look at the chart right here, we can see that PayPal is down 80.68% from its all-time highs and has traded sideways for the better part of the last 2 years, which is a very long time. So why is the stock down so much? Well, I think there are three major reasons for that. One, the company's growth rate has slowed down quite significantly. You can see that annual revenue has grown by high double digits from 2014 to 2021, but since then, revenue only grew by single digits over the past 2 years. Secondly, active accounts on the platform has plateaued since December 2022 and then gradually declined over the last few quarters. So this is not a good look at all because it means that merchants and consumers are migrating out of the PayPal ecosystem and that PayPal might be losing market share to competitors. Thirdly, and I think this is the most important one, is that gross margin has been falling over the last few quarters, which means PayPal has low pricing power and that it is losing earnings potential. So those are the three main reasons why the stock is down so much. However, I think PayPal is on the verge of a real turnaround. I think management, aka the new CEO Alex Chris and his new hires, have what it takes to improve the fundamentals of the company. I think with his leadership and experience, PayPal could return to stronger growth. And we're already seeing him in action with his new hires, with new product launches and pricing changes to PayPal's products, which I believe can reaccelerate the business, build a more engaging payment ecosystem, as well as improve gross margins. And while we wait for the business to turn around, we can basically buy the stock on the cheap with a forward PE multiple of just 14 times and an EV to sales multiple of just 1.83 times. Price to free cash flow is even more ridiculous at just 9.29 times. And the company is incredibly profitable with a net margin of 14% and a free cash flow margin of 16.38%. They have cash on hand of $14 billion and a net cash position of $2.6 billion, so the balance sheet is really strong. And let's not forget that the company is buying back shares very aggressively. And as you can see, the company over the last 12 months bought back $5.3 billion worth of stock. And in Q1 alone, the company bought back $1.7 billion of stock. So that is an annual run rate of $6.8 billion. So to put that into perspective, with its current market cap of $62 billion, PayPal can basically buy back around 10% of its shares outstanding, which is absolutely insane. Now, let me give you a picture of how share buybacks can compound investor returns. So I think I've shown this chart in X. Basically, this shows the share price evolution of AutoZone, ticker symbol AZO. But what the company does, it doesn't really matter. But as you can see, ever since the company IPO'd in 1991, the company's market cap has expanded by 4,600%. So that's a 46x. But here's the interesting part. Its stock price over the same time frame has increased by 37,000% or 370x over the same time frame. So 370x in its share price versus 46x in its market cap. And that is just ridiculous, right? And that is only made possible because the company has been buying back shares very aggressively, with shares outstanding decreasing by 87% over the same time frame. So what I'm trying to say here is that PayPal can increase its share price way more than its market cap, and that's because of its share buyback program. And so far, the company has reduced shares outstanding by 14% since its IPO back in 2015. And as you can see, it is dropping very quickly. And I think this share buyback is going to act as a support for the stock price, which means downside risk is quite limited here. And over the long run, I think its share price could be a major compounder for investors. So this is why I'm bullish on PayPal and why I have a decent position in the company. My price target is $106 a share, which is almost double from its current price of $58 a share. Okay, now we are entering the top 4 positions in my portfolio, with the fourth largest position being Grab Holdings, ticker symbol GRAB, which represents 9.31% of my portfolio. So if you're unaware, Grab is the leading super app in Southeast Asia, providing deliveries, mobility, and digital financial services across 8 Southeast Asian countries. It is also often regarded as the Uber of Southeast Asia. Now, the main reason why I own Grab is because the company has one of, if not the strongest moats I've ever seen in a business. Now, according to Morningstar, there are 5 moats that a business can have, and I think Grab has all 5 of these moats. So, intangible assets. Grab has a strong brand moat and is probably the most well-known and most downloaded super app in Southeast Asia. Now, switching costs. Grab offers the most complete catalog of products and services in a single app, and as consumers use more of Grab's products, they are more ingrained in the Grab ecosystem, which makes it hard for them to switch to another provider. Network effect. As of Q1, Grab has 38.5 million monthly transacting users, growing 16% year over year. The company also has 4 million plus merchant partners and 5 million plus driver partners. So as the ecosystem grows, Grab will enjoy powerful network effects. Cost advantage. As of Q1, Grab's adjusted EBITDA was $62 million. Its closest competitor, Goto, which owns Gojek and Tokopedia, still has negative adjusted EBITDA. So that's a clear sign of cost advantage mode for Grab. And lastly, efficient scale. Again, Grab is the leading super app in Southeast Asia. In the food delivery category, the company has a 55% market share in the region. In the mobility category, Grab also has a high market share given that it operates a duopoly with Gojek in Indonesia, and that means in other Southeast Asian countries like Singapore, Vietnam, Philippines, whatever, I think Grab's mobility business has much more market share in those countries. So with all these moats, I'm confident that Grab will sustain its leadership position for years to come and allow it to capitalize on the growing Southeast Asian economy, which happens to be in the early stages of its digital transformation, So, a lot of growth runway ahead for Grab. The company's revenue is growing rapidly, up 44% year over year in the last 12 months alone, and is expected to continue to grow over the next 2 years at 17% in 2024 and another 17% in 2025. And while the company is still unprofitable on a GAAP basis, keep in mind that all of Grab's profit lines are improving. For instance, in Q1, operating loss improved by 63% year over year. Segment adjusted EBITDA improved by 332% year over year, and free cash flow improved by 53% year over year. So I think Grab could turn net income positive again by the end of the year, which could be a major catalyst for the stock. But nevertheless, I think Grab is on the right track towards profitability. In addition, the company has a net cash position of $4 billion on its balance sheet with virtually no debt. And to put that into perspective, that is about 30% of its current market cap of $13.36 billion, which is insane. And looking at the chart right here, the company's stock is still down 80% from its all time highs and has a forward EV to sales multiple of just 3.28 times, which is quite cheap considering its durable moats, margin expansion opportunity, and growth story. And as for me, I have a price target of $6.44 for Grab stock, which is almost double from its current price of $3.37. So I'm extremely bullish on Grab holdings. So now we are down to the top three positions in my portfolio. And before we move on, I would appreciate it if you guys can do me a small favor and hit that like button and subscribe to my channel, as it helps this channel reach out to more investors. That said, stock number 11 in my portfolio and the third largest position is SoFi, ticker symbol SOFI, which represents 11.23% of my portfolio. So SoFi is another fintech company in my portfolio, and it basically offers consumers a one-stop shop for all things finance, including digital banking, loans, stock investing, insurance, and more. The company also operates a separate financial technology platform called Galileo, which offers B2B financial services such as card issuing, payment processing, and digital banking. Now, here is why I'm bullish on SoFi. First, SoFi is growing its member base like crazy. And as you can see, SoFi has consistently grown its member base every single quarter to 8.1 million members as of Q1, which is up 44% year over year. Now, I've said this many times, member growth is a leading indicator of revenue growth. So as long as SoFi's membership continues to grow, continues to climb, we can expect revenue to climb up as well. And judging by its momentum, I think SoFi might just break 10 million members by the end of the year. So because of this member growth, revenue growth has been really strong, with the company growing revenue at a 3-year CAGR of 48.6%, which is very, very impressive. Also of important note, all three of SoFi's business segments, namely lending, technology platform, and financial services, have now been profitable on a contribution profit basis for 3 quarters in a row. And the company keeps gaining operating leverage, which is why the company is now GAAP net income profitable with a GAAP net margin of 14% as of Q1. And keep in mind that SoFi achieved these numbers with minimal growth from its lending segment, more specifically its student loans and home loans segment. As you can see by these orange and purple bars, they are not growing. They have very little growth over the last few years. However, rate cuts are on the horizon, which should boost lending activity in the short to medium term, which should also drive overall growth for SoFi. With that being said, I expect growth to continue to be robust and profitability to continue to improve as well, which should lead to earnings growth over time, and that should be a tailwind for the stock. In addition, SoFi has a perfect track record of beating analyst revenue estimates ever since the company went public in Q2 of 2021. As you can see, it's all beats right here. So I expect the company to beat their own guidance and outperform expectations, which should drive the stock price higher as well. Valuation wise, the stock is still down 70% from its all time highs, and as it stands, the stock trades at a forward PE ratio of 68 times, which is quite expensive, but I think it's inappropriate to value SoFi using PE ratio, since the company just turned profitable and is still in growth mode. Instead, we can look at price to sales, and as you can see, the company trades at a price to sales multiple of just 3.5 times, which is incredibly cheap for a fast growing profitable company like SoFi. As for me, I have a price target of $15.67 for SoFi stock, which is more than double the current price of $7.11. So I'm bullish on SoFi, and I hope we can go back to double digits soon. Now, moving on, my second largest position in my portfolio is cash, which represents 17.7% of my portfolio. So a pretty large position in cash, and that means I'll be ready to buy during any dips or corrections. I mean, if we look at the Buffett indicator, which is the best single measure of where valuations stand at any given moment, according to the man himself, we can see that the indicator is at an all time high, much higher than the levels that we can see in the dot com bubble in 2000 or even the great financial crisis back in 2007. So that is a concern, and I think the market is quite overvalued. And according to this indicator, at least it is overvalued. So I will take caution, and I don't want to be complacent here. So that is why I have a decent cash position in case the market sell off, which I think we're seeing in the last few days. And also, especially elections and the Fed rate cuts are coming. So that could cause more volatility in the markets. And I want to be prepared for that. And that is why I have a big cash position in place in case we see a drawdown or a big dip in the markets or even in the stocks that I have. And when that happens, I'll be ready to add to my positions. Now, the last stock in my portfolio, my largest position, and longtime followers of my channel knows this, is HIMS and HERS, ticker symbol HIMS, which represents 18.7% of my portfolio. So HIMS make up a sizable chunk of my portfolio, mainly because of the recent rally that we've seen with HIMS stock over the last year or so, with the stock up, 167% in the last 12 months and also 131% this year alone. Now, if you're not familiar, Hims and Hers is a hyper-growth telehealth company that is disrupting the healthcare industry, where it is notorious for its complexity, unaffordability, and unaccessibility. So Hims is changing all that through its telehealth platform, providing consumers access to high-quality medical care that is highly convenient, accessible, and affordable, all at their fingertips. Now, the company has been the subject of multiple short reports and controversies, but time and time again, HIM stock continues to, prove the doubters wrong and continue to outperform expectations and improve its fundamentals. As you can see, the company has been growing its revenue at a 3-year CAGR of 77% and a 5-year CAGR of 100%, which is absolutely insane. And while revenue growth is slowing down, which is expected as a company grows over a larger base, analysts still expect revenue to grow by 36% in the next year, in the next 2 years, which is quite impressive. And I don't think analysts have factored in the recent launch of the company's GLP-1 product, which is a drug for weight loss that has been gaining a lot of attention lately. And I think this new offering will attract way more subscribers into the platform and significantly contribute to the company's growth over the next few years. So I expect a lot of upward revisions from analysts in the near future, which could push the stock price higher from here. So one thing I love about HIMS is that the company has a very compelling business model with a software-like gross margin as high as 82.41% with recurring revenue, because most of its revenue comes in the form of subscription revenue. So very high quality, high margin revenue, which means consistent, predictable earnings growth and high earnings potential. While the company is still unprofitable with a net margin of negative 0.25% over the last 12 months, the company is actually gaining a lot of operating leverage. And as you can see, the company's net profit margin, quarterly net profit margin, has been improving over the last few quarters. And as of Q1, the company has a net profit margin of 4%, which is way higher, which is a decent improvement from last year's negative 5.3%. So, with this kind of growth momentum and operating leverage, margins are set to expand even more, and that means we can expect earnings to explode in the near term, which could be a prime catalyst for the stock. Other than that, the company has a strong balance sheet with virtually zero debt and a net cash position of $191 million. The company is also free cash flow positive with a free cash flow margin of 6.53%. So expect its balance sheet to continue to expand from here. In terms of valuation, the company trades at an EV to sales forward EV to sales multiple of 3.52 times, which is quite cheap in my opinion. I mean, if we look at the company's historical EV to sales multiple, we can see that the stock is still trading at the bottom range of its historical multiple. So even despite the recent run up that we've seen in the share price, I think him stock is still attractively valued. So as for me, I have a price target of $30 a share for him stock, which is still about a 40% upside from its current price of $22.51. So if you ask me if I'm selling my shares at these levels, absolutely not. I think the stock is still undervalued. In addition, the company is only a $5 billion market cap company. I think it has the potential to 10x from here to a $50 billion market cap company. So I don't think that's crazy to imagine. I think $50 billion market cap is very much possible given the company's growth momentum and execution so far, and the fundamentals are improving and everything is just going in the right direction for hims and hers. So no reason to sell here unless something drastic happens like the CEO stepping down or something even worse, which I'm not sure what it is. So there you have it. This is my portfolio. Obviously, this is going to be very volatile given the nature of these stocks, especially today when the market is selling off and my whole portfolio is down 2.58% in a single trading day. But of course, I don't gauge my performance over weeks or months, but rather over years. So I'm not bothered if I underperform the markets in the next 3 weeks or 3 months. I'm more interested in beating the market over a longer time frame of at least a year. With that being said, if you guys are interested in following my portfolio, you can do so by subscribing to my portfolio at savvytrader.com. It is $25 per month though, but it will give you live updates and trades in my portfolio and some other exclusive content that I intend to publish there. So if you're interested, the link to my portfolio is in the description box below. Well, I hope you guys enjoyed watching this video because it's not easy sharing my portfolio to the public. I feel exposed. But whatever it is, I want to hear your thoughts. What do you think about my portfolio? Do you think it will outperform in the next few years? And what about you? What are your top 5 positions? Please let me know in the comment section down below. And with that being said, thank you guys for watching this video, and I'll see you guys in the next one.